This next question comes from Advait Prasad in New York. He writes, today, Berkshire holds over $300 billion in cash and short-term investments, representing about 27% of total assets, a historically high figure compared to the 13% average over the last 25 years. This has also led Berkshire to effectively own nearly 5% of the entire U.S. Treasury market. Beyond the need for liquidity to meet insurance obligations, is the decision to raise cash primarily a de-risking strategy in response to high market valuations, or is it also a deliberate effort to position Berkshire's balance sheet for a smoother leadership transition, providing Greg Abel with maximum flexibility and a clean slate for future capital allocation decisions?
Well, I wouldn't do anything nearly so noble as to withhold investing myself just so that Greg could look good later on.
This question, asked during the Berkshire conference back in May, cuts right to the heart of what many investors are worried about right now. It's a situation that is only getting worse as the year has gone on. We'll play Warren's full response later in the video, but first, let's set the stage. Berkshire's cash pile has now climbed to a record-shattering $347 billion, the largest in its history. That number alone has sent shockwaves throughout the investment world, because when the most famous and most skilled investor on the planet refuses to deploy that kind of money, people start asking one simple question. Why? The prevailing belief is clear. Warren Buffett is quietly preparing for something big, a massive correction, and the scary part is he's not saying it, he's signaling it through his actions. Of course, some will say it's just speculation, but when the man who has built his legacy on investing capital decides to sit on hundreds of billions for years, that's not normal behavior. It's unprecedented, and as you'll see, there's a growing pile of evidence that suggests Buffett is far more bearish than he's letting on. And let's start with something most people completely missed. Buried on page 7 of Warren Buffett's 2023 annual letter is a single quote, one that if you really listen sounds less like reassurance and more like a quiet warning. He writes, I believe Berkshire can handle financial disasters of a magnitude beyond any heretofore experience. This ability is one we will not relinquish. When economic upsets occur, as they will, Berkshire's goal will be to function as an asset to the country, just as it was in a very minor way in 2008-9, and to help extinguish the financial fire rather to be among the many companies that inadvertently or otherwise ignited the conflagration. At first glance, it sounds noble. Berkshire will be the hero in the next crisis, but if you actually break down what he's saying, it's chilling. He doesn't say if a crisis happens, he says when. That's not speculation, that's certainty. He doesn't say a normal downturn, he says a magnitude beyond any heretofore experienced. Bigger than 2008, bigger than anything we've seen in our lifetimes. And then he positions Berkshire as the one holding the hose while the rest of Wall Street burns. This isn't just corporate PR, it's a playbook. Berkshire is bracing for a storm, not hoping, expecting. And when that storm hits, they're not planning to run, they're planning to buy. There's really no other plausible reason for holding this kind of cash. No matter how Warren spins it, the message is loud and clear. You don't build a war chest of this size unless you're expecting something big, something that cracks the surface. And honestly, this shouldn't shock anyone. Nearly every chart, every indicator, every measure of excess is flashing the same warning. We're not just in a bubble, we're staring down one of the biggest speculative manias in economic history. We all know the usual suspects. I'm not going to spend 5 minutes breaking down the Buffett indicator, the Shiller ratio, or the PE ratio because everyone from YouTubers to economists has already dissected those to death. We all know what they're showing. The Buffett indicator is at all-time highs, the Shiller cape is brushing up against its historical peak, and PE ratios are floating in a zone we usually only see before something breaks. But what most people ignore are the quiet indicators, the ones buried in liquidity data and balance sheets, the ones that don't make headlines but tell a far more dangerous story. These aren't just hinting at a bubble, they're screaming it. Every single ratio tied to excess is flashing red. Take the market cap to M2 ratio. It doesn't sound exciting, but it exposes a fatal flaw in the market. Think of it as a liquidity-adjusted Buffett indicator. It shows how massive the US stock market has become compared to the actual cash and money supply backing it. When this ratio runs hot, it means there's far more paper wealth than real liquidity in the system, and that makes the market fragile because when the selling starts, there simply isn't enough cash to absorb the blow. On the bottom of the equation is M2, that's cash, checking accounts, savings, and money markets. On top is the entire value of the US stock market. At the peak of the dot-com bubble in 2000, this ratio hit 3.03, the highest ever recorded. What followed was one of the most punishing investment periods in modern US history. The S&P 500 fell by nearly 50%, but the real pain wasn't just the drop, it was the 13-year stagnation that came after. From 2000 to 2013, the S&P didn't meaningfully break its old highs, an entire decade plus of lost time. Inflation eroded real returns, valuations deflated, and investors who bought at the top were stuck. Obviously, it's easy to look back and say dot-com bubble like it was a quick pop. It wasn't. It was a slow grinding bleed that crushed retirement accounts, funds, and portfolios, and all of it happened right before this ratio blew off the top. And now we're back in this dangerous territory. The market cap to M2 ratio sits at 2.91, just a hair below the dot-com record. Meanwhile, the Buffett indicator, Shiller Cape, and PE ratios are all at or near their own peaks. This means this isn't just one overextended measure, it's everything at once. Every warning light is blinking. The difference is this time liquidity is thinner, leverage is higher, and concentration is extreme. History doesn't always repeat, but when the signals line up this cleanly, it often rhymes in brutal ways. And this is exactly what Warren is thinking about. Just listen to the rest of that first answer.
Now, the amount of cash we have, we would spend, well, we came pretty close to spending $10 billion. Not that long ago, for example, but we'd spend $100 billion. I mean, and those decisions are not tough to make. When something is offered that makes sense to us and that we understand, and offers good value, and where we don't worry about losing, we would rather have conditions that are developed where we would have like 50 billion or something like that, but that just isn't the way the business works. And we have made a lot of money by not wanting to be fully invested at all times. And we don't think it's improper, actually, for people who are passive investors just to make a few simple investments and sit for their life in them. But we've made the decision to be in the business, so we think we can do a little better than that by behaving in a very irregular manner. Things get extraordinarily attractive very occasionally.
And you see the point I'm trying to make. Warren is never going to outright say, well, I expect the market to crash in the coming 2 years, but you can read between the lines and get a sense that he believes Berkshire has done so well at this scale because it's able to buy companies at desperation pricing. And right now we have the opposite, and he's willing to wait until those conditions develop. Now, in my opinion, that's just a fancy way of saying he's waiting for the crash. Now, I doubt that he has any idea when that will happen, but I don't think that he's completely ignoring the timeline either. If you have 300 plus billion in treasuries sitting around at this point, it's sort of acting like a pseudo put on the market, which tells me that he expects this excess to blow up sometime in the coming years. It might be next year, 2 years from now, or 5 years, but sometime in the medium term, and that's what he'll never admit in a direct question. Simply put, creating this big of a war chest, in my opinion, is admitting that yes, we are in a bubble and I expect it to blow up sometime soon. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it. And if you have a moment, please take a second to check out the sponsor of this video, foreclosure.com. They're the nation's leading source for distressed properties with over 1.8 million listings, foreclosures, pre-foreclosures, tax liens, and more, updated 24/7 so you're never looking at stale data. You can find the link in the description or pinned in the comments. They're offering a free 7-day trial, no risk, no commitment. Thank you for supporting.